Central bank tool to deal with liquidity shortage. The three types of liquidity shortages, central bank, acute institution-specific funding, and systemic funding and market, do not always occur in isolation. Important interdependencies exist, and the occurrence of one can lead to another with dynamics that often reinforce one another. For example, acute concerns about the viability of a particular institution can rapidly spread to a loss of confidence in other institutions, resulting in systemic disruptions in the interbank market that, in turn, hamper the distribution of reserves among participants, leading to problems in the payment system. Indeed, the current crisis that began in mid-2007 has involved all forms of liquidity shortages. 7. In their capacity as LOLR, central banks essentially have three tools with which they can influence the availability of liquidity in the financial system. The first is lending or borrowing in the open market. These operations include the repos and reverse repos that are the bread and butter of liquidity management during normal times. They are not targeted at specific institutions, though they may be undertaken bilaterally, but are designed to address system-wide liquidity pressures. The operations are typically collateralized and conducted at the discretion of the central bank. The basic function is to regulate the level of aggregate reserves to ensure smooth functioning of the payment system and facilitate the attainment of the relevant policy interest rate target. That said, these operations can be utilized and structured to address a broader set of problems as well. For example, through these operations, central banks may lend not only reserves but also highly liquid securities such as government bonds. The second tool is the outright purchase or sale of assets in the open market. These operations affect the aggregate supply of central bank money, reserves, on a permanent basis and are typically conducted in sovereign bonds denominated in either domestic or foreign currencies. Prior to the current episode, similar interventions in other asset markets were rare. The purchases of equities by the Hong Kong Monetary Authority during the 1997 Asian financial crisis and by the Bank of Japan in 2002 were notable exceptions. The application of outright transactions aimed at affecting market prices is quite controversial and is usually justified in terms of correcting a fundamental misalignment in asset prices or the provision of two-way liquidity. Finally, central banks can conduct transactions directed at specific institutions instead of markets as a whole. Unlike open market operations, these transactions can take place at the discretion of either the central bank or the financial institution itself, involve the channeling of liquidity directly to or from particular institutions, and can be either collateralized or uncollateralized. Examples of such operations include standing facilities and traditional emergency lending assistance. The specific institutional setup of each of these three tools varies a great deal across countries, including differences in maturity, frequency, counterparty arrangements, and eligible collateral. These variations can have significant implications for how financial institutions manage their own liquidity positions as well as for the liquidity characteristics of various assets themselves. 8. Moreover, the specific setup of each of these tools crucially determines their function during a liquidity crisis. Depending on their structure, each can in principle contribute to the alleviation of all three types of liquidity shortages discussed earlier. The key features that characterize their application to various types of crises are set out below and are summarized in the table. Unsurprisingly, the choice of tool to be employed will depend on the type of liquidity shortage that has arisen. Critically, this means that unlike the framework set out by Bagehot in the 19th century, there is no unique set of principles that governs how the LOLR should respond. Before describing how central banks use their tools to respond to each of the aforementioned liquidity shortages, it is useful to note some key implications for their balance sheets. The fulfillment of the LOLR function typically involves changing the composition of assets held by the central bank, the overall size of its balance sheet, or both. In doing so, central banks will normally offset any impact on reserve balances outstanding in order to maintain the policy interest rate near its target. The main exceptions to this are, 1. If there is an aggregate shortage of central bank liquidity, 2. If the policy rate is 0, or 3. If reserves are remunerated at the policy rate. Whether the overall size of the balance sheet expands or not then depends on the choice of offsetting operations. If the latter is achieved by allowing one asset to substitute for another, then balance sheet size is unchanged. However, if the offset is achieved through the issuance of various forms of central bank liability, such as an increase in the size of the government's deposit balance or the sale of central bank bills, balance sheet size increases. Typically, the latter becomes necessary as the scale of liquidity support rises beyond a certain point. When central banks are faced with a shortage of reserves in the banking system as a whole, the primary aim of their intervention is to maintain the smooth functioning of the payment system and keep interest rates near their targets. If the problem is largely one of insufficient aggregate supply, all three forms of central bank intervention can be employed to address the situation. Generally, however, the preferred option is to accommodate the extra demand for reserves by lending in the open market and relying on the market to distribute reserves to those most in need. the provision of additional reserves would typically not be at a penalty rate since the maintenance of the appropriate aggregate supply of reserves is an important remit of central banks. Moreover, the underlying cause cannot generally be attributed to mismanagement on the part of banks. The sharp pickup in demand for liquidity buffers that began in August 2007, for example, reflected a general rise in uncertainty regarding future funding needs that was largely unforeseen. If the shortage of reserves is caused by problems related to their distribution within the banking system, a situation associated with frictional payment shocks that leave some institutions suddenly and unexpectedly short of funds, the LOLR function can be implemented through directed liquidity support. Standing facilities, where banks can either deposit excess balances or borrow additional balances directly from the central bank at pre-specified rates at the end of the day, are designed to handle these situations. Since the nature of the problem envisaged is largely transitory, this type of liquidity support is designed to be extended for a very short term, usually overnight. Moreover, to maintain the incentive for financial institutions to transact in markets, central banks tend to make access to standing facilities at penalty rates of interest. Finally, standing facilities can exert a stabilizing influence on markets without any funds actually being lent, since their mere presence can act to assure banks of orderly access to overnight funds. This effect is ensured by making access unambiguous. Regardless of whether the central bank liquidity shortage is system-wide and institution-specific, the operations conducted to address it are designed explicitly to minimize the impact on market prices of all securities other than the overnight interest rate. As such, their implementation has no bearing on, nor is it in conflict with, the official stance of policy. Furthermore, since the terms are very short and all loans are fully collateralized, the central bank faces virtually no credit risk. The principles behind standing facility lending are in fact very much in line with conventional interpretations of Bagehot's instructions to lend freely to solvent institutions, against good collateral, at a penalty rate. As emphasized by Paul Tucker, much of the central bank lending that was discretionary in Bagehot's day has, in effect, become hard-coded into the operating framework, Tucker 2004. While these operations work well most of the time, the current crisis has highlighted some potential constraints that may arise in the use of both open market operations and traditional standing facilities. For one, financial institutions may not have sufficient access to the types of assets that the central bank regards as being of acceptable quality to serve as collateral. In addition, the institutions most in need of central bank liquidity may not have direct access to the central bank itself. As recent experience has shown, development of more global capital markets has made it more likely that disturbances will originate in markets and involve counterparties that are several steps removed from the central bank's sphere of direct operation. Finally, when financial institutions lose confidence in nearly all potential counterparties, bringing their soundness into question, access to standing facilities can become stigmatized, impairing the effectiveness of these facilities as a liquidity backstop. This was particularly evident in the United States during 2007 and 2008, when market rates at times rose well above the interest rates on the facilities. See Committee on the Global Financial System, 2008. As we discuss in more detail in Section 4, central banks have addressed these problems by widening the pool of eligible assets, broadening the range of institutions with which they are willing to transact directly, and assuring market participants that borrowing from standing facilities should not be regarded as a sign of weakness. When the official sector confronts an institution facing an acute shortage of funding liquidity, the justification for intervention must be that failure threatens the stability of the entire financial system. In such a circumstance, the solvency of the institution will be of secondary importance. Instead, central bankers are faced with a decision whether to exercise discretionary authority to provide emergency lending assistance to a particular institution. Clearly, this situation is distinct from the one just described, in which an institution finds itself short of funds at the end of the day. Rather, the problem is one of large-scale and potentially prolonged shortages of funding liquidity against which the use of standing facilities is inadequate or inappropriate. Furthermore, given the institution-specific nature of the intervention, emergency lending assistance can be clearly separated from the monetary policy stance. Any liquidity support extended in this situation will likely expose the central bank to credit risk, since an institution in need of a loan of last resort will typically have exhausted its stock of both marketable assets and acceptable collateral. So the assets pledged to the central bank are likely to be some part of the borrowing bank's loan book, or a liquid securities, or some physical asset whose value is uncertain. To the extent that a loan extended under this circumstance is, in the end, simply bridge financing while a takeover or major restructuring of the recipient institution is organized, it will generally be accompanied by a plan for private sector, Bear Stearns, or government, Northern Rock, support or recapitalization. This acts, at least in principle, to limit the central bank's exposure to substantial losses. A key factor determining the scope and scale of emergency lending to an institution facing an acute shortage of funding liquidity is the central bank's ability to absorb losses. In this context, the current crisis highlights serious potential resource limitations. As financial institutions have become increasingly globalized, the scale of any potential support required has grown tremendously, requiring the joint participation of fiscal authorities. Moreover, in cases such as Iceland in 2008, it can even stretch beyond the limits of the entire official sector. Because of the moral hazard implications, officials are tremendously hesitant to grant such loans. When they do, they not only charge high rates of interest to mitigate taxpayer exposure but have the ability to write down shareholder equity as well as replace management. Insofar as the institution is unable to obtain funding on its own in the market, however, the provision of liquidity support cannot necessarily be deemed punitive relative to the market rate. 9 As a further counterbalance to moral hazard, the provision of support to acutely illiquid institutions is on a discretionary basis so that the market does not take it for granted. Such constructive ambiguity does not necessarily mean, however, that the general set of principles that would justify emergency lending assistance should not be made explicit. Taylor, 2009, for example, argues that uncertainty about what the government would do to aid financial institutions, and under what circumstances, was a key factor in the deterioration that marked the current crisis. Once an emergency loan is granted, communication can be critical in determining the chances of success. On the one hand, the announcement of assistance may work to assure the public that the financial system is sound, thereby boosting confidence among market participants. On the other hand, news of liquidity support may confirm public fears about potential failures, and the institution receiving support may suffer a further loss of reputation. In the United Kingdom in 2007, news of LOLR support to Northern Rock precipitated a retail deposit run, which was stopped only by announcement of a government guarantee. In the wake of this incident, banks understandably became unwilling to access central bank lending facilities even for more benign liquidity needs, for fear of reputational consequences. The result was a further tightening up of the money market, which worsened an already bad situation. While stigma is surely not a relevant issue for an ostensibly failing institution seeking emergency lending assistance, the central bank's decision to grant a request may worsen the stigma associated with all forms of direct lending, complicating liquidity management. Confidentiality may help to prevent knowledge of LOLR support from giving rise to panic, but maintaining it is difficult in practice since banks usually know the approximate condition of their competitors, and the scale of such operations would typically necessitate public oversight. The limits of the central bank's LOLR function are most severely tested in a systemic liquidity crisis, not least because such situations are likely to be accompanied by the other two types of liquidity shortages as well. In this circumstance, the underlying aim of official intervention is to shore up confidence in the financial system as a whole, restoring market functioning through the re-establishment of both funding and market liquidity. This will help forestall asset fire sales, facilitate the orderly reduction in borrowing, support the process of price discovery in markets, and restore credit flows. Succeeding will almost surely require utilization of all of the forms of central bank liquidity intervention described earlier and may involve substantial modifications in standard practices and procedures. In addition, as is fairly clear, the central bank could well become exposed to considerable market and credit risk. In a systemic liquidity crisis, the key challenge facing central banks is to find ways to contain flight to quality and re-engage the private sector in the intermediation process. Such re-engagement will occur only as agents' uncertainty over outcomes is reduced. To this end, the central bank will have to perform an intermediating role, and its actions may be designed to supplement the role of banks or even bypass banks altogether. Indeed, whereas the primary function of the LOLR in traditional discussions is to liquefy the balance sheet of banks, the current crisis has highlighted that when faced with a systemic crisis in a market-based financial system, the scope of LOLR support is likely to be much broader and involve interventions more akin to liquefying the limit order book of a particular market. Typically, this will require a broadening of the central bank's provision of liquidity both in terms of accessibility and structure. Tensions in the term funding market, for example, can be alleviated by the central bank both directly, through greater provision of term funding that offsets some of the shortfall in market supply, and indirectly, through the assurance of access to liquidity directly from the central bank. To the extent that the latter helps to ease intermediaries' concerns about rollover risk, they may become more willing to extend term loans. At the same time, the set of institutions with which the central bank transacts may need to be expanded to ensure that the interventions reach those most in need. A basic thrust of liquidity operations during a systemic crisis is to accommodate the increase in demand for assets of unquestionable quality while at the same time financing those institutions that find it hard to borrow in the market. This involves shifting the asset composition of central banks' balance sheets away from highly liquid assets, primarily government securities, toward less liquid ones, typically private sector debt. In some instances, it may be necessary to sidestep the banking system and provide funding directly to borrowers and investors in key credit markets. This may be accomplished through outright purchases of, or lending against, specific classes of debt linked to particular market segments, for example, mortgages or corporate bonds. By reassuring investors that a committed buyer is in the market, such interventions may reduce the liquidity premium on various asset classes and boost the flow of credit. More generally, market prices may be influenced through the portfolio balance effect, whereby the change in the relative supplies of imperfectly substitutable private and public securities will lower the premium that the private sector demands for holding risky private securities at the margin. In addition, by making an asset eligible for central bank operations, the liquidity premium that might otherwise be needed to induce investors to hold that asset will be reduced. Because the purpose of these policies is to affect market pricing of specific assets independently of the overnight rate, it will be difficult to distinguish them from the stance of monetary policy per se. They also represent a departure from the conventional view that monetary policy should refrain from directly influencing relative prices by not targeting specific asset prices. Indeed, whether yield spreads are too wide or whether specific bonds are rationally priced given the amount of risk inherent in the prevailing economic outlook is largely a subjective assessment. Justification for such policy actions, then, rests on the same logic that has been used to motivate foreign exchange interventions, the enhancement of two-way liquidity or the attempt to move a misaligned asset price. Ultimately, though, a systemic crisis is less amenable to central bank intervention. Central bank tools are much more limited in this context, since the fundamental problem is more greatly removed from monetary policymakers' sphere of influence. The bulk of market and funding liquidity is generated through transactions among private entities and, as such, is created endogenously in the financial system. In an environment where there is pervasive uncertainty about banks' balance sheets, both because asset valuations of various types become problematic and because of incomplete knowledge about what assets each bank holds, a central bank's liquidity operations can ease these problems only indirectly, alleviating the symptoms rather than the cause. Central banks can provide liquidity by transacting with market participants, but they are not able to directly ensure that private agents will transact with each other. In the end, whether central bank actions are effective in attenuating the impact of a systemic crisis and restoring the functioning of markets depends on the extent to which they have a catalytic effect on mutually voluntary private sector transactions. A key aim would be to generate a virtuous cycle that relies primarily on the private sector to re-establish liquidity in interconnected markets. In this respect, announcements of intended actions can be sufficient if they are credible. During the 1987 crisis, for example, the Federal Reserve not only encouraged banks and securities firms to make credit available to brokers and dealers but also issued very public statements affirming its commitment to providing liquidity. Carlson, 2007, argues that the latter was critical to stabilizing the situation. By extension, ambiguity of access to central bank liquidity facilities is likely to be counterproductive during a systemic crisis. On the contrary, uniform access for all financial institutions, irrespective of their condition and systemic importance, is more likely to alleviate heightened counterparty fears. Standing facilities and loan guarantees are examples of intervention that can have this kind of catalytic effect without the liquidity actually being drawn upon. For example, several of the new facilities introduced by the Federal Reserve in the current crisis are available at the discretion of market participants, the PDCF, AMLF, CPFF, MIF, and TALF, while others appear to have been structured to encourage market intermediation of credit. Point 10. Importantly, the implementation of such measures involves an intricate balancing act. To the extent that an expanded intermediation role discourages financial institutions from dealing with one another, the central bank's response may create countervailing forces between catalyzing market activity on the one hand and substituting for it on the other. The onus then falls on the design of an appropriate pricing structure and well-defined exit strategies, both of which can be difficult to achieve in practice. Finally, in a situation of generalized market failure, it makes less sense for liquidity support to be provided at a penalty rate relative to prevailing market rates since no particular institution is benefiting relative to others. In fact, liquidity support will often, and probably should, be provided at a subsidized rate when it involves an illiquid asset in which a market price cannot be found. That said, liquidity facilities may be designed in ways so that accessing them is not punitive when markets are dysfunctional and is punitive when normal activity returns. Point 11. Doing so would also naturally lead to an automatic runoff of liquidity support as markets stabilize. The creation of moral hazard is a long-standing concern associated with LOLR operations. Goodhart, 2007, for example, argues that generous provision of liquidity by central banks, in normal times and in times of crisis, has made banks careless in managing their liquidity risks. With this in mind, it is useful to assess the nature of moral hazard in light of the different types of liquidity shortages we set out here. As will become apparent, we view the moral hazard created by the LOLR as either relatively unimportant in practice or an issue that is best addressed by other facets of policy not directly associated with the provision of liquidity support itself. With respect to shortages of central bank liquidity, the potential for moral hazard arises if the provision of liquidity support reduces the incentive for financial institutions to devote resources to enhancing the efficiency and effectiveness of their daily liquidity management operations. Moreover, excessive reliance on the central bank for daily liquidity management would substantially undermine private interbank market activity. Central banks have generally responded to these issues successfully through the establishment of a pricing structure that preserves the incentive for market participants to trade with one another before going to the central bank standing facility. Looking at the case of an acute shortage of funding liquidity at specific institutions, we note that the underlying moral hazard concern is that the extension of liquidity assistance could establish precedents that lead to lax risk management and make financial institutions generally more vulnerable to shocks. Attempts to address these concerns have centered on both the prevention of potential problems through regulatory frameworks such as prompt corrective action and the imposition of highly punitive financial and non-financial penalties on management and shareholders in the process of crisis resolution. The latter makes it unlikely that expectations of liquidity support will directly contribute to the taking on of excessively risky activities. Nevertheless, to the extent that creditors are protected from losses, the exercise of market discipline is weakened. This in and of itself may facilitate, rather than cause, the pursuit of excessively aggressive business strategies. Finally, in situations of systemic crisis, the underlying coordination failures that trigger the crisis cannot be easily attributed to anticipation by private agents of government support measures in the event of a financial meltdown, so it is difficult to see how it could have been the outcome of moral hazard. Indeed, if one views the evaporation of liquidity in key financial markets as a form of market failure, associated with the inability of markets to cope with aggregate, as opposed to idiosyncratic, liquidity shocks, a case can be made that the provision of liquidity support in systemic crises serves to enhance social welfare. See, for example, Kearns and Lowe, 2008. At the same time, expectations of generalized liquidity provision by the central bank in systemic crises may lead institutions to neglect the task of building buffers that can be run down during such events. In this way, the inherent financial fragility that potentially contributes to making systemic crises more likely may be partly attributable to complacencies in risk management associated with anticipation of central bank intervention. This does not, however, constitute grounds for the central bank to refrain from providing support should a systemic crisis occur, nor does it suggest that provision at that time should be on highly punitive terms. Economically and politically, authorities have little choice but to act in the midst of a crisis, and any ex-ante stance precluding provision of such support cannot be made credible. Thus, even if the existence of the central bank's liquidity facilities creates moral hazard, efforts to mitigate it are more productively channeled elsewhere. Insofar as crises are associated with complacency in risk management, mistaken assumptions about asset price trajectories that become evident only ex post, skewed compensation arrangements, limited liability, and overall financial conditions that encourage risk-taking, the burden of their prevention falls more naturally on the appropriate management of macroeconomic policies and regulatory structures than on the specifics of the framework for emergency liquidity provision.